Now, the implications for the syndicated loan market are twofold. First of all, companies hold and are increasingly holding digital assets. Tesla reportedly is sitting on $1.5 billion worth of Bitcoin. It doesn't take much to see a corporate treasurer wanting to monetize that position by borrowing against it and securing a margin loan over the digital assets the company holds, or by posting them as collateral under a more traditional secured syndicated loan. In the US, there is a burgeoning market in margin loans being offered in traditional loan format, which is secured over Bitcoin and other cryptocurrencies. These are increasing in volume and significantly increasing in ticket size, and it's only a matter of time before there will be demand for these types of products this side of the Atlantic. The second reason that the syndicated loan market should take note of developments in the digital asset space is that syndicated loans themselves could become digital assets. Over the last couple of years, a lot of work has been undertaken to digitize loans. People have been looking at putting them into a blockchain environment to assist with secondary trading and loan administration. When this is achieved, loans, of course, become digital assets, and this has significant implications for market participants, particularly for lenders who will want legal certainty around how these loans are traded when they are in digital form. They'll also want legal certainty as to how they can manage their balance sheets using securitization structures, CLOs, repos, and other funding mechanics where loans are either transferred or delivered as collateral. So, two answers. We think the syndicated loan market would be wise to take note of developments in the digital asset space, because there will certainly be demand from corporates to post these as collateral. And secondly, loans themselves will become a form of digital asset. The interesting point to note here is that tried and tested techniques for taking security over custodied assets could well be applied to digital assets. It's most likely that when you take security over a digital asset, you will use some form of mortgage or charge where the asset is transferred from the borrower's wallet to a wallet in the name of the secured party or a third-party custodian. And now, the reason that it will be important to transfer the digital asset from the borrower's wallet is that for so long as the digital asset remains in the borrower's wallet, the borrower has control over the asset because it has knowledge of the digital key, which allows the borrower to transfer the digital asset. And so in order to certainly ensure that a lender has a fixed security interest or to otherwise exercise domain over the digital assets and to avoid double trading, it will be important that assets are delivered to a wallet in the name of the secured party or a third-party custodian, which is a slight difference to the way that you sometimes take security over, say, custodied securities. Now, when you transfer digital assets to custodians, you, of course, introduce custodian risk. And the market, if digital assets are to become an acceptable form of collateral, will want to see established custodians providing custody services in relation to digital assets. The good news is that European and UK regulators are certainly looking at providing legal frameworks which will make it easier for existing custodians to extend their offerings to digital assets. Another practical point to consider is how do you deal with price volatility and valuations, particularly at times outside normal operating hours. Bitcoin is valued 24/7, 365 days of the year. Given its price volatility, there will often be the need for a margin call. What happens if there's a need for a margin call over a weekend when the custodian may not be open, when the lender may not be open to deliver sufficient margin notices? What type of collateral would need to be posted to meet that margin call? If it's fiat currency, will parties be happy to accept that that may not be able to be posted until a couple of days later? Another point to consider, which is unique to digital assets, is that any form of security arrangement will need to deal with forks or airdrops. Forks arise where there is a change in the protocols used for establishing transactions involving a digital asset. Any security arrangement will need to deal with the resulting property that arises from a forked blockchain. As for airdrops, these are effectively free tokens which are delivered to the holder of a digital token from time to time. The security arrangements will need to look at who is entitled to receive those, what value, if any, should be given to them, whether they should be included in the collateral package. So these are just some of the legal and practical points that you'd need to consider if you were taking security over a digital asset. The law of England and Wales does not currently provide legal certainty as to the status of digital assets. While the market treats digital assets as property, and certainly the courts have, in the context of cases involving proceeds of crime, treated Bitcoin as a form of property, digital assets do not necessarily fit easily into the types of property which are recognised by English law, which are things in possession and things in action. Items like Bitcoin actually fall somewhere in between. And this raises a conceptual problem under English law, which has implications for how digital assets are legally transferred, how security can be taken over them, whether a custodian could take a traditional lien over a crypto asset, which is held in a custody account in the same way that they would with other assets. All of these are important questions for the market if digital assets are to be an acceptable form of collateral. Now, the Law Commission has been appointed to propose changes to English law to accommodate digital assets. It has recently launched a call for evidence in which it is seeking market feedback on how the market might accommodate digital assets now and in the future. The call for evidence is open until 30 July 2021, and it is expected that a consultation will be launched towards the end of the year with proposed changes to law. This will be important for the market's acceptance of digital assets, and in particular will the syndicated loan market with becoming more comfortable with digital assets as a form of collateral.